The main question we're going to answer is this. Is this wave of analyst upgrades a signal of a rare buying opportunity? Or is it a dangerous valuation trap, ready to catch investors right at the top? By the end of this, you'll have a clearer, data-driven picture to help you decide. We're going to give you the information you need to look at this company not just as a stock, but as a business, and make a smart decision. So, what exactly happened that got the market so fired up? On January 12th, 2026, analyst Tyler Radke from Citigroup dropped a major report. He upgraded Palantir from a neutral rating all the way to a buy/high risk, and at the same time he cranked his price target up to a staggering $235 per share. Coming from someone who was cautious before, this was a huge vote of confidence that the market couldn't ignore. But it's why he upgraded that's really turning heads. Radke and his team believe we're seeing the start of a supercycle for both commercial and government spending on AI. They're projecting that Palantir's total revenue growth for fiscal year 2026 could be between 70 and 80%, with the government part of the business alone growing by 51%. To put that in perspective, those numbers are way above what most of Wall Street was already hoping for. Citi's argument is that after talking with chief information officers at major companies, it's clear that AI budgets are getting bigger and being rolled out much faster. This isn't just for experiments anymore, it's becoming a must-have. At the same time, they see huge momentum from government spending, thanks to a global push for military modernization and a desperate need for better data intelligence. And Citi isn't the only one feeling bullish. This upgrade joined a chorus of positive notes from other big firms. Bank of America now has the street high target at $255, while Truist and Phillips Securities have both initiated coverage with buy ratings. When you see multiple respected analyst teams all coming to the same conclusion around the same time, it's a powerful signal. But here's the problem. Analysts don't set returns. Valuations do. They are all pointing to the same things: an explosion in companies adopting AI and a long-term bull market in government tech. This flood of upgrades suggests that Palantir's growth is not just continuing, but speeding up, forcing even the skeptics to take another look. On the surface, it makes the stock look like a no-brainer. But as we know, the surface rarely tells the whole story. Now, before you run off to buy the stock, let's get a dose of cold, hard reality. Especially with the company's Q4 earnings report confirmed for February 2nd. After so many great quarters and all these upgrades, expectations are through the roof. Palantir doesn't just need to meet expectations, it needs to absolutely crush them and give mind-blowing guidance for 2026 to justify its current price. Anything less could be seen as a huge failure and be the pin that pops the valuation bubble. For every analyst singing Palantir's praises, there's a bear pointing to one huge glaring issue: its valuation. Let's talk numbers, and I want you to let these sink in. Palantir trades at some of the most extreme multiples in the entire stock market. We're talking about a price to earnings, or PE ratio, of around 422. A forward PE based on next year's estimated earnings of around 170 times. And a price to sales ratio hovering near 100. For context, the average PE for the S&P 500 is usually between 20 and 25. Most fast-growing software companies are considered pricey if they trade at 20 times sales, let alone 100. Palantir's valuation is in another universe. This is what bears mean when they say the stock is priced for perfection. The current stock price isn't just reflecting today's success. It's assuming years, maybe a decade, of perfect execution and insane growth. Any hiccup, slowing growth, new competition, and the reason for this premium price could disappear overnight. This isn't just some fringe opinion. Despite a few loud bulls, the overall analyst consensus on Wall Street is still a hold. For every buy rating, there are many more analysts on the sidelines, not willing to recommend the stock at these prices. Some are straight up bearish, like Jefferies analyst Brent Phil, who has a sell rating and a street low price target of just $70. His argument is simple. The valuation is way too high compared to other software companies, leaving very little room to go up and a massive risk of going down. If you dig deeper, some models based purely on discounted cash flow suggest the company's real value might be closer to $60 per share, a huge gap between the fundamental value of the business and the narrative-driven price of its stock. Then there's the risk of a so-called AI bubble. We've seen this movie before. In the late 90s, any company with .com in its name shot to the moon before the bubble burst. Today, anything with AI attached to it is getting a similar boost. The danger is that if the market gets scared of an AI bubble, Palantir could get dragged down with it, no matter how well the company itself is doing. When expectations are this high, the risk is just as big. So with that huge wall of worry and a valuation that would make a value investor sick, why would anyone, especially a major bank like Citi, be so incredibly bullish? The answer is that the bulls are looking past the current numbers. They see a tidal wave of growth so powerful that they believe it will not only justify today's price, but make it look cheap down the road. To understand their argument, let's break it down. First, and most importantly, is the absolute explosion in Palantir's U.S. commercial business. For years, people said Palantir was just a government contractor, stuck with slow, clunky federal budgets. That story is now officially dead. In its last reported quarter, Q3 2025, Palantir's U.S. commercial revenue grew by a mind-bending 121% year over year. That is not a typo. 121%. This is the engine driving the whole bull case. The secret sauce is a game-changing sales strategy called AIP Bootcamps. Forget long sales cycles and boring PowerPoints. Palantir now sends its engineers directly to a potential customer for a few days. They take the customer's actual data and in that short time, build working AI tools that solve their real problems. This does two brilliant things. First, it takes all the risk away for the customer. They see it work in their own messy environment before they write a huge check. Second, it shrinks the sales cycle from months or years down to days or weeks, letting Palantir sign up customers faster than ever before. This bootcamp model is a customer acquisition machine, and it's running at full steam. The second pillar of the bull case is Palantir's financial fortress. While many high-growth tech companies are burning cash to grow, Palantir is a fortress of financial strength. As of its last report, the company had a war chest of $6.4 billion in cash and, critically, zero debt. This is a massive competitive advantage. It means Palantir can fund its ambitious R&D and global expansion without needing to raise money or pay interest. It's completely self-sufficient. On top of that, the company is a rock star when it comes to the Rule of 40, a key metric for software companies. The rule says a healthy company's revenue growth rate plus its profit margin should be at least 40%. Palantir's score last quarter was an almost unbelievable 114%. This shows a rare combination of insane growth and amazing profitability that very few companies on earth can match. Third, the bulls point to the numbers beneath the surface that show this growth is real. The total contract value, TCV, Palantir signed in Q3 was a record-breaking $2.76 billion, up 151% year over year. This is the future revenue being built today. The number of huge deals is also exploding. The company closed 204 deals worth over $1 million, including 53 deals worth over $10 million in that quarter alone. These aren't small projects. They are massive long-term commitments from some of the world's biggest companies. Finally, let's simplify the tech. The reason Palantir gets such a premium price is because it isn't just selling an app. It's selling an entire operating system for making decisions with data. Think of it like this. Gotham is the original platform, built for the complex and high security needs of governments and spy agencies. Foundry is the version for businesses, letting a huge company connect all its scattered data into one clear picture. And now, the artificial intelligence platform, AIP, is the AI brain that sits on top of everything. AIP lets customers not just see their data, but use AI to ask it questions, run simulations, and even automate complex decisions. Palantir isn't just another AI company. It's the foundation that makes enterprise AI possible. Even with all this momentum, none of this guarantees linear growth. Execution risk is still real. The bulls believe that in a world drowning in data, the company that provides the secure system to make sense of it all is destined to become one of the most important tech companies of our time. They don't see the high valuation as a risk, but as the market slowly waking up to this new reality. So where does that leave us? On one hand, you have the bears shouting about an astronomical valuation that seems totally disconnected from reality. They point to triple-digit price-to-sales ratios and warn that the stock is priced for a decade of perfection, making it a ticking time bomb. On the other hand, you have the bulls, armed with a flood of analyst upgrades and pointing to a business that is firing on all cylinders. They see a commercial business growing at an incredible 121%, driven by a revolutionary sales model. They see a financial fortress with billions in cash, no debt, and a Rule of 40 score of 114 that puts it in a class of its own. They see a company building the fundamental operating system for the entire AI revolution. So is Palantir worth paying this price for after this big upgrade? As always, this isn't financial advice and you have to do your own research. The answer really depends on your timeline and how much risk you're comfortable with. If you're a short-term trader or an investor who can't stomach wild swings, the bear case is strong. The valuation is undeniably high and the stock could easily get cut in half if growth slows or the market turns down. The risk is real and shouldn't be underestimated. However, if you're a long-term investor with a 5 to 10 year horizon, the bull case gets a lot more interesting. The question isn't about next quarter, but whether you believe Palantir will become the essential data OS for the world's governments and biggest companies. Do you believe that 121% commercial growth is a sustainable trend? If you do, then the argument is that paying a premium today for a truly one-of-a-kind company could lead to huge returns over time. The key is to separate the price you pay from the value you get. The bulls are betting that the future value of Palantir will make today's price look like a bargain. Ultimately, the choice is yours. You have to weigh the undeniable explosive growth against the equally undeniable extreme valuation. Now, I want to hear from you. This is one of the most debated stocks out there. Let me know in the comments below, are you buying, selling, or holding Palantir? And what's the biggest reason for your decision? I read all the comments and really want to see what our community thinks. And if you want to stay ahead of the curve on the most important AI stocks and get deep dive analysis like this, make sure you're subscribed with notifications on. You won't want to miss what's coming next. Thanks for watching, and I'll see you in the next one.